Bank of America believes precious metals will remain central to investor portfolios in 2026, with gold continuing to function as a primary hedge while also contributing meaningfully to returns. The bank argues that tightening supply conditions, rising production costs, and persistent global uncertainty are creating a supportive backdrop for higher prices and stronger earnings across the sector. Analysts expect gold to retain its defensive role, while silver is increasingly viewed as the higher risk, higher reward opportunity as the cycle matures. According to Bank of America's analysis, gold supply among major North American producers is likely to contract modestly next year, with output projected to fall to about 19.2 million ounces. At the same time, all-in sustaining costs are expected to climb toward roughly $1,600 per ounce, reflecting inflationary pressures and the growing difficulty of expanding mine output. This combination of constrained supply and rising costs is seen as a powerful driver of profitability, with total EBITDA for the covered companies forecast to surge by more than 40% to around $65 billion in 2026. The bank expects gold prices to average roughly $4,538 per ounce next year, supported by strong investment demand and limited responsiveness from supply. This outlook builds on an exceptional 2025, when gold gained sharply and reached new record highs. Even after occasional pullbacks driven by dollar strength or profit-taking, price action remains biased to the upside, with analysts emphasizing that short-term volatility has not altered the broader bullish trend. Beyond traditional macro drivers such as real interest rates or the US dollar, ongoing economic and policy uncertainty is seen as the dominant force underpinning gold demand. Investors continue to rebalance portfolios towards safe haven assets, while central banks are maintaining a steady pace of accumulation. Gold's share of global reserves has risen significantly, yet it remains relatively small compared to historical norms, suggesting room for further official sector buying. With supply largely inelastic in the short term, changes in demand, particularly from ETFs, futures, and options markets, are expected to play an outsized role in determining price levels. While some valuation measures suggest gold is trading above long-term real price trends, analysts argue this does not necessarily signal an imminent peak. Relative metrics paint a more balanced picture, especially when comparing gold to silver or to global equities. The gold-to-silver ratio has fallen sharply from recent extremes and now sits near levels consistent with long-term historical averages, indicating that gold no longer appears expensive relative to silver. This shift has brought renewed attention to silver, which many strategists see as the potential standout performer in the next phase of the precious metals cycle. Historically, gold tends to lead during the early stages of a bull market, while silver accelerates later due to its smaller market size, higher volatility, and sensitivity to both investment flows and industrial demand. With the current gold-to-silver ratio still well above past cyclical lows, even a partial reversion could imply substantial upside for silver prices. Silver's appeal is further strengthened by its dual role as both a monetary and industrial metal. Demand linked to renewable energy, electronics, and other technology-driven sectors could provide an additional tailwind if global manufacturing activity improves. Investment positioning also appears relatively light compared to gold, raising the possibility that incremental inflows could have a disproportionate impact on prices. Some long-term projections from Bank of America suggest that, under historical ratio dynamics, silver could ultimately trade far above current levels, potentially reaching triple-digit prices if conditions align. While such outcomes are viewed as longer-term scenarios rather than near-term forecasts, they highlight the asymmetric upside that continues to attract risk-tolerant investors. Recent market action underscores the volatility inherent in precious metals. Gold and silver have both seen sharp intraday swings, with prices occasionally retreating on stronger dollar moves or ahead of key U.S. economic data, including labor market reports that may influence expectations for Federal Reserve policy. Despite these pullbacks, analysts broadly agree that lower interest rates, persistent geopolitical risks, and elevated uncertainty continue to favor non-yielding assets over the medium term. Overall, the outlook for 2026 reflects a familiar division of roles within the precious metals complex. Gold is expected to remain the anchor, providing stability and protection amid uncertain macroeconomic conditions, while silver offers greater volatility and the potential for outsized gains. With supply constraints, rising costs, and strong demand dynamics still in place, both metals are likely to remain at the forefront of investor attention in the year ahead.